Good afternoon, dear students. We are continuing the lecture on the Federal Reserve System of the United States and the central banking in general. And today we're going to continue studying the Federal Reserve of the United States. In the past few weeks, we studied the Federal Reserve System, the origins of the Federal Reserve System, the origins of central banking. Then we did study some of the most important and significant crises, financial crises in the United States, in Europe, in Britain. Today we'll try to understand the workings of the central banking system in the United States after the Great Depression and during the Great Depression, and also from last time, as a reminder for you, the central banking function, one of the main central bank's functions is that it serves as a lender of last resort. And when there is a banking crisis in the United States or anywhere in the world, in any country, central banks should lend money freely, and when it does it, when there is no financial panics, these financial panics are mitigated through central banking when central bank or any kind of central bank, whether it be in Great Britain, the Bank of England, or the United States Federal Reserve System, and if any kind of institution, central banking institution, as a lender of last resort, as a helpful institution. It's a government agency actually, and it helps to identify some of the very important tools, how it works and things like that. The Fed is the shortcoming for, as the short word or the abbreviation of the Federal Reserve System, right? The Federal Reserve System, FRS, is actually translates as the Fed, and maybe they do that. It is easier to understand. I'm not saying FRS. Instead of FRS, they say the Fed. It's easier, it's more convenient to use. I also think that it's easier to use. In the Great Depression, the Federal Reserve System was not really successful. Many competitive banks collapsed. That was a period of serious economic crisis in the United States, both in the United States and in Europe. In particular in Germany, where there was an uprising and Hitler came to power, and it led to the Nazi dictatorship in Germany. And then there was the Second World War, which was the direct cause of the Great Depression, of high unemployment in Europe, in particular in Germany. There was a really serious problem of that sort of unemployed people. There were millions of people unemployed. They were lining up in front of all those institutions. They were desperate, actually. The people in Germany were desperate, they were hungry, and in this kind of situation and the development of democracy, this period in Germany was the period when people believed that by doing democracy, you could spare the population from many serious dangers when the market can do anything you want, when there's invisible hand and economists believe that it's better leave the things as they are. Laissez-faire, laissez-passer, things like that. But that was a big mistake. The government did not interfere with economic policies, and the people were tired of such a democracy, and they voted for the Nazi party of Hitler, Adolf Hitler. He came to power, and there began a period of serious political changes in Europe. Then the Second World War, the Great Patriotic War, then the Second World War comes to an end, and then I think at this point they realized that the system, if it's left as its own, is really going to fail. There needs to be some kind of government intervention, and Roosevelt, when he came to power in the United States, I mean Franklin D. Roosevelt, he called upon economists to try to develop a program which would be really helpful for any economy, macroeconomic situation. And his idea was that government should interfere with economic policies, with macroeconomic policies in any country. When there's a crisis, you should actually pump or inject money into the economy, and this injection would help the economy develop, the economic growth starts, and everything else starts working again. The Fed appeared to agree with the liquidationist theses at this time, and it believed that banking and credit had expanded too much in the 1920s and needed to be reduced. Roosevelt's economic policies, well, actually, from last time, as a reminder for you, I would like to point out to the idea that at this point the economic theory, the economic ideas of Roosevelt's government was he was trying actually to create some institutions that would help stop the banking panics, and if there is a banking panic, it should be mitigated through ways such as lending freely, like Walter Bagehot brought in Lambert Street at the end of the 19th century, when there were particular situations in the banking system of the United States or in any other European government was trying to interfere more. It lent freely to the commercial banks in those times, and instead, or as a basis, as a guarantee, the government received some sort of insurance, and this insurance was these kind of cooperation. It was called the FDIC, the Federal Depository Insurance Corporation, and this FDIC was a government agency also that was some sort of a guarantee to the whole financial and banking system, and it created lots of confidence into the US banks and things like that. So he was really successful in doing these policies. Actually, the FDIC was the greatest progress, and this was a government intervention policy. At this point they realized that the banking system should not be left all on its own accord. It should be regulated. Of course, the other thing which he did was he ended the gold standard. The gold standard was a heavy burden on the economy, and by 1933 the US government decided that it should leave the gold standard and go to a more flexible regime of the currency. And they, of course, gold was still a sort of a insurance policy, so to speak, because it stored value, but it was kept at the vaults of the central bank, and this money could not be used in direct circulation of the currency circulation. So the period of gold standard came to an end, and this period was also the period of huge political changes. In 1939 the Second World War started, and the whole world actually was on the war. And in those days, countries such as the United States government, the British government, they decided that the gold standard was a thing of the past, and it was a serious threat to the economic development of any state. So it was really difficult to try to keep interest rates at a stable level. It was really difficult to try to mitigate the currency risks, and it was really difficult actually to keep that fixed exchange rate of any currency to the gold, like the US dollar or British pound against gold. It was central banks were not perfect institutions. They were a part of the financial system, and many countries were on the gold standard, and this was the reason for them to try to keep with the policy they did on a regular basis. And what they did, the United States in particular was on the gold standard, and they believed if they would just print money, issue more money and inject more money into the markets, this would have had negative impact on the dollar to the gold exchange rate, or the dollar to any currency in the world. The exchange rate would fluctuate really, and that was a situation when those people in central banks understood that they must put an end to that sort of things, and they should really be more confident about the economic system and how it worked. And in this way they were on the point of creating a more sustainable approach to the global financial system, or a national financial system, the national currency system. They created lots of institutions, government agencies, that helped to mitigate financial crises, and they thought that financial crises were things of the past, and their nation was the most prosperous nation on earth, which was not really true. But still, some of the ideas and some of the most important difficulties in those times were taken directly from the experience of the Great Depression. The Great Depression actually had two periods, and it was at this point when economists started thinking about creating something more comprehensive and adaptive to the financial system, and they they tried to transform the system, make it more flexible and global. The Great Depression in the end was a phenomenon that helped understand the dynamics of the international system, the international banking system of any country involved in this particular situation. So, and it played an important role. The Federal Reserve failed in its two basic tools. It failed because it believed in a liquidationist theory. It believed that spending freely was a threat to the economy. It was a threat to the monetary system. The supply of money was limited. It was contracted actually, and at this point the economy collapsed even further. There was a double dip situation. The bottom line was really harsh. The people were desperate, like I said. There were many unemployed people. The system was working badly. It was not healthy, but still the liquidationist theory and the lessons that the Federal Reserve experienced was a sort of financial system that was more adaptive, more flexible. It created many opportunities for the commercial banks in their development in the United States, and this was really an important issue. In the past few weeks before the Second World War, before the 1939, people were still living in the world which was really sort of unpopular. That was really sort of convincing, I should say. People did not believe that this war, they actually felt that there's something in the air that was some sort of a cloud which was still threatening the financial system of the United States, and this system actually collapsed because there was the Second World War, and everyone understood that there must be created something more effective, more comprehensive and difficult, when the things should have been more flexible or at least adaptive to the sort of policy the United States government led. And by 1944 there was the Bretton Woods currency conference in Bretton Woods, New Hampshire, United States, and there were 44 countries, the representatives of these 44 countries, and they actually created the new basis, a new basis for the global world currency system, and the system was working, they tried to make it more effective, and they did it. They did a great job in creating a new financial system, the new world system. It was created. The International Monetary Fund was created. we will want to keep these lessons which were listed in mind when we will go over to the next block of information, which we are about to start at this point, and we'll talk in more details what was the Fed's response to the crisis of 2008-2009. Next lecture will review the developments in the central banking practice after the Second World War, World War II, including the sources of the recent financial crisis. So this is the end of lecture 1, and we're going over to a next lecture. I welcome you back here today. I'm really glad to see you again. You're smiling, that's good. That's good news. Actually, when people smile, that means good mood. Good morning, everyone. I'm welcoming you at the second lecture on the Federal Reserve System of the United States. In this lecture, lecture 2, we're going to speak a lot about the Federal Reserve after the World War II. We're going to cover 3 issues. These 3 issues include early challenges. Early challenges, that means some sort of the period, actually at the late 1930s and the beginning of the early 1940s. Then we're going to talk a lot about the Great Moderation. It was also a great period of economic threats and opportunities and things like that. And then we're going to speak a lot about the origins of the recent crisis. That means the crisis of 2008, 2010, or in the United States it was in 2007, 2009 actually. So the timing of the crisis was not really good for the population of many countries. It hit countries across the world. It was a global phenomenon again. And the situation was really difficult at this point. The people started feeling that this was a sort of a situation when some sort of new ideas should have been created in order to keep with technological advances and things like that. So we'll start with the mission of a central bank. This is some sort of a revision, so to speak. This is the revision from the previous lecture, where we started to understand the workings of the Federal Reserve System and the origins of central banking. Today we're going to study the mission of a central bank. Again, its mission is some sort of policy, and this policy, the central banking policy, is sort of difficult actually to understand, but as times go by we will be able to understand it really so that you could employ some of the ideas, some of the techniques that we used in these course of studies. Macroeconomic stability and financial stability are the things that we think about when talking about central banks in particular, because these functions cannot be performed by normal commercial banks. These functions can be performed only by central banks, and this system is actually a system that is really effective in its workings. We will try to understand the dynamics of commercial banks, and in particular the central bank, how it operates. In 1951, they adopted a new legislation, the Fed Treasury Code of 1951. These are key points to keep in mind when thinking about the regulations that were taken as the basis at this point. The bottom line of the system was that, of the central banking system, was that it could help mitigate financial panics, and it stemmed from the idea that central banks were the government agencies that could create certainty in the financial markets and the foreign exchange markets. It was struggling with these difficulties. During World War II and subsequently, the Fed was pressed by the Treasury to keep longer-term interest rates low to allow the government debt accrued during the war to be financed more cheaply. And this was really some sort of idea. When they kept interest rates low, they ensured the economic situation in this country, and they were sure that central banks were on the point of changing into really supportive and a leading instrument in the monetary policy. They created many opportunities for companies to develop. They created many instruments. Keeping interest rates low, they were trying to mitigate financial panics. They were on the point of producing more effective tools. They tried to modify and transform some of those tools of macroeconomic stability and financial stability. They were on the point of new challenges after the World War. And at this point they created more government agencies that help mitigate financial risks, the foreign exchange risks and things like that. In 1951, the Treasury agreed to make new amendments, and it amended many ideas. It created new legislation. Before that, before 1951, why are we talking about this date, 1951? At this point, the US government was changing into some sort of new financial system, because the Federal Reserve System was not an independent institution. It was dependent on the Senate. It was really pressed by the Treasury. The Treasury was, at this point, a very important government agency that created the currency. They issued government bonds, so this was a really important institution to have at this point. They were actually on the point of trying to achieve economic stability. The Fed has remained independent, and it's still independent thereafter. In 1951 it became a completely independent institution. It conducted monetary policy. It was there were many challenges, like I said, for this financial institution. They tried to develop new tools, macroeconomic tools, in response to short-term political pressures, and they were to foster economic stability. And this economic stability should be really... Now the point here is that central banks should be independent institutions. That's the most important idea of the central banking in general. The idea about central banking is that each country, first of all, has to have some sort of institution that helps create the it creates the currency, it circulates the currency, and this currency at this point actually it should be supported by its value should be supported by the central bank, which it does on an effective basis. The US government and the US Federal Reserve System is an independent institution. It consists of 12 most important Federal Reserve banks across the country, and this is, of course, some economists would say this is a private corporation because only 25% of its shares or its holdings are in direct control by the government, but still the Federal Reserve System is a government agency. There's no getting away from it, from that. So it was to foster economic stability without political pressures. And the Fed in the 1950s and 1960s, early 1960s, between World War II and the recent financial crises, macroeconomic stability was the predominant concern of central banks. This system was functioning actually, it was, they were aware of the political challenges in those days, in the 1950s and in the early 1960s. William McMartin was the chairman of the Federal Reserve System between 1951 and 1970. This was 2 decades. Almost 2 decades of his leadership was, the results were really good. His ideas, his policies were effective, and they were really effective for the United States economy. And at this point they created lots of government agencies that helped to mitigate financial risks, macroeconomic risks, by keeping good policies and things like that. At this point, they were most importantly there was a predominant concern of central banks. This period of macroeconomic stability they really tried to create new opportunities for the population, for corporations, and his idea about macroeconomic policies in general was that inflation, he said, inflation is a thief in the night, and if we don't act promptly and decisively, we will always be behind. So, the period of his reign, so to speak, in the 1950s, 1960s, was a great period of economic leadership. His idea about the financial system was really to stabilize inflation rates. He was, at this point, he was a really influential banker. He wrote many articles about how to deal with the economic situation, and starting in the mid-1960s, monetary policy was too easy, he said. Inflation was a constant problem in the year's economy, and at this point new economic policy should be created, should be introduced to the new financial system after World War II, because the central bankers and people in government understood that these things should be done anew, and inflation was really a problem through the 1960s and 1970s. In the 1970s, this was actually a period of huge global transformations. This was a period when economists and economies in particular were threatened by the oil crisis. In the early 1970s and late 1970s and early 1970s was a period of huge inflation. Inflation was really a problem. In 1973 there was a war. The war raged between Israel and Pakistan. They were created, these economic and political difficulties were created by oil prices, because this was a period of huge military activities in the Middle East in particular. In 1960, OPEC was created or established. OPEC meaning Organization for Petroleum Exporting Countries, OPEC. Venezuela initiated this idea. They introduced new government policies because they thought that advanced countries were really on the point of using or taking advantage of the developing countries. At this point, the developing countries or emerging countries understood that they were exploited by the most important countries in the world. Inflation peaked at about 13% at this point. The Great Inflation period And why was monetary policy too easy at this period? Like I said, in 1990s there were at least 18 oil shocks in the global economy. The United States at this point was a sort of country that bought oil from the Middle East countries, especially Saudi Arabia. They bought it in the amounts necessary or in immediate demand or supply. They were made important, these factors of production. Oil is actually the blood of our civilization. It's called black gold. It is a strategic currency, so to speak, of the modern of the economy that was still in existence in those times, because oil is a transport fuel, and transport fuel meaning that cars and logistics were dependent on a system. Inflation pressures accumulated really quickly in this period. The economy was hot. It could not run without generating inflation pressures, and monetary policy at this point was really easy. So the mistake of the Federal Reserve System, they actually, after the Great Depression, they tried to pursue a more flexible idea of monetary policy. They kept interest rates really low to stimulate the economy. Things were really good because Europe was still in ruins after World War II. European governments required huge amounts of money and loans from international institutions, and they were all supported by credits in US dollars. The new system was created. Like I said, this was a period of Bretton Woods system in 1944 and 1971. August 15th, 1971 was an end point in the development in the Bretton Woods system. It collapsed by 1971, and in 1976 Jamaica system was created, and Jamaican system became powerful elements of the global economy. Actually, inflation was not at this point inflation was a great threat, and this was the second mistake. So during the Great Depression they kept interest rates high because they thought that keeping interest rates low would throw them off of the gold standard. But now the gold standard, it was no longer in existence, but the US dollar was pegged to the dollar at $35 an ounce. So this was a period of fixed exchange rates, and interest rates were really low. When inflation began to rise, monetary policymakers responded too slowly. Exacerbating factors were there were many factors actually behind some sort of economic threats and opportunities for the emerging economies and things like that. Oil and food price shocks in late 1970s. The emerging markets were on the point of collapse. So this was a period of great challenges for the global economy. New policy tools should have been created. All these problems led to the direct creation of the new monetary system in Europe. The system was called the European Monetary Union. The European Monetary Union with a new currency, which was called ECU, the European Currency Unit, and fiscal. War actually is a really good mechanism to to try to make the economy go, because war means new military. It means that they can print more money, they can issue government bonds, and they may construct new factories to build weapons of mass destruction. So this was a really challenging period. They created new threats and opportunities to the system. They were trying to identify new rules and things like that. The Great Depression ended, and World War II ended, but still small conflicts, military conflicts kept on repeating, and they were on the point of collapse actually. Fiscal policies that stretched economic capacity. Nixon's wage price controls that artificially held down inflation for a time. Central banking in an evolving economy. In 1970, there was a new person for us to lead the central banking industry. Central banks changed a lot, starting from the 1970s, because inflation was a threat, and they thought they were trying to find new techniques in order to be able to stem inflation, to stem economic difficulties, and try to mitigate financial risks and foreign exchange risks. There was a period of high inflation. The inflation problem was too acute, and it was actually created by oil shocks and things like that. The world economy at this point, in the 1970s, and by the end of the 1970s, the European Currency Union was created, and it was created in response to inflation challenges in those times. The US dollar was at the point of collapse, because actually it was. I don't mean that it was really on the point of collapse, but there were countries, especially West Germany and Japan, two new and powerful economic centers of the global economy, because Japan was one of the greatest manufacturers of automobiles. Germany was the greatest exporter of their goods and services to the world market, as well as Japan. So they created new industries, and they were working in the line with these sort of ideas that was that was really challenging. This period was a real challenge for the economy of many states. And these experiences illustrate how central banks have to struggle with an evolving economy and imperfect knowledge. Then came Paul Volcker, chairman of the Federal Reserve System, 1979-1987. He was a new person in the government. He was one of the most influential central bankers. And he created new ideas of the central banking system. His idea about inflation was to keep it in strict terms. He thought that they should restrict and keep in bounds inflation. They were on a point of collapse again. The US government, there was a dramatic break in the way that the monetary policy should operate. So there were again two parties, so to speak. Two ideas were kept in mind, that inflation is a concern and it should be struggled, and because it's a thief in the night, it steals the value of money, it steals money from your pockets, it makes poor people poorer, and it makes rich people richer. So at this point he tried to mitigate some political risks. He was under great pressure, this person. Today we remember especially his ideas about central banking is that they should keep interest rates within particular bounds. At this point, the central banks in the world were concerned about inflation problems, of course. First of all, in 1979, there was a new war in Afghanistan. Soviet troops went to Afghanistan. The United States and the world community were under threat. Again, oil prices skyrocketed, and again the inflation problem was a significant problem, a significant issue, and because they should have thought about new forms and ideas how to stop economic collapse that was threatening the US economy. And by the end, in 1976, the new system was introduced. This world currency system was called the Jamaican system. In 1976 is the starting point when Jamaican system started working. So Kingston Agreement was underway. The Bretton Woods system ended, it collapsed in 1971. Nixon signed new legislation to end a fixed exchange rate of the US dollar to the gold, and they allowed currencies fluctuate a little bit, further developing the international monetary system. The dollar was still the global currency, and inflation problems in the United States led to the idea that the European community or European Union should adopt new monetary policy. They created actually a new currency, and this currency, it was not a currency in a general understanding. It was not the euro, it was not the dollar. It was called the European unit of account, the European the ECU, European Currency Unit, which was some sort of electronic money that was not used in circulation, but it was used in transactions between the European countries, because the US dollar was under threat at this point, and they created new challenges. They started to create new opportunities for practical understanding of the central banking policies and how they did in this particular period. So the Volcker disinflation period was a really a good period for the global economy. In some sense, what they did was that the US government was not actually managing its exports and imports really properly. Imports were on the rise and exports were on the decline. In the United States, and there was a new society. This society was called some sort of abundant society, things like that. They were buying everything on credit, so they bought more and more products, and they imported more than they exported. Trading deficits was created. Billions of dollars were poured into the US economy, and inflation was a real problem in this period. In practice, the new approach to monetary policy involved high interest rates, tight monetary policy, and to slow the economy and fight inflation. And inflation in the 1980s was sort of a period when the government institutions and the monetary institutions, central banks, understood that they should create something that could help the economy out of economic crises. And in the years after the new disciplined monetary policy began, inflation fell markedly, despite the fact that he was under great pressure. He managed to go through these political pressures. Still, in the end, he was forced to leave his post, but at this point his policies did not stop, actually, because after him the